I've got another interesting example to show you how this budget is going to help in intergenerational equality. Let's just look at that. So you can see on my screen, I've got this example where we've purchased some capital asset for $20,000, and then the sales proceed is $40,000. In the terms of calculating the capital gains, you can see that you've got $20,000 as a nominal gain, and the other income which you have is just $10,000, which means you are barely earning anything. Now, in that particular case, you can see if you apply the 50% CGT discount, you would have got basically $10,000 as a discount, and you also had your other income on top of that, which was $10,000. So you would have to just pay taxes on 18,200 and above, which comes out as $288. Now look at that second example where we do the calculation based on the revised method that the government is proposing. Someone who is actually not earning much, right? So look at how it impacts him. Same example, basically sales proceed is still $40,000, cost base is $20,000, and even for this purpose of example of taking a CPI uplift of 8%, which is more than Australia could ever get, the gain still remains at 18,400. Now, because the government has proposed that there's going to be 30% minimum tax on the CGT, you have to pay that 30% tax on the indexed gain. So in this particular example, we'll have to pay 18,400 into 30%, and you reach to that $5,520 mark. And then basically, if you would have to pay taxes on, through the marginal rate of tax, you would have to pay $1,600. But because the government has proposed you have to pay 30% tax on the capital gains, you would have to pay 30% tax on the capital gains that you have made, which means people who are earning less than, the $45,000, they would be actually worse off in this example where they would have to pay 30% tax on the capital gains straight up. This is another example which I wanted to show. If you sold the asset after 1st of July 2027, you would have to calculate your capital gains in two parts. One is going to be pre 1st July 2025, and the other one is going to be post 1st July 2025. So pre July 2025, you would have to use the 50% discount method, and after that you would have to go to the indexation method. So you would have to find whatever the market value of the security was on that date, and then you will calculate a discount up to that position, and then post you would have to use the indexation method, and again you would have to pay 30% minimum tax if during that period your income is less. So I don't understand how this particular capital gain segment is going to help the people who are basically not earning much. I don't understand how it's going to help them.